Muy bien, buenos días a todos por venir. Os dejáis aquí el primer fila vacía, ¿no? Los invitados. Okay, let's go to switch to English because this section will be in English. I would like to thank all of you for coming here. And Neil Atkinson the first. This is the second time he came here. Last year he came here in March to present this oil report for the next 2 and 5 years. This is the report. As all of you know, we have very good relationship with him and with all the energy agency officials. And this is the second or the third one we are presenting here. The first was the coal. As you know, they have 5 reports: coal, oil, renewables, gas, and ETP in technology. We normally present all of them here through the years. This is the third. This is the second time we did with the oil report. And well, I'm going to give him the floor. And before I try to present him, he has worked in Petróleos de Venezuela. He's a very official. He knows Spanish, but he won't speak Spanish, and he prefers to speak in English as a British national. A British national. He works in media companies too. He has experience in this communication area, in the media area, and he has different experience in the think tank and all consulting. And he joined the IEA in 2016. This is 2 years, more or less, 1.5 years. No? This is the main analyst in the oil sector, and he's going to present a long-term strategy for long-term report about oil and the short-term at the end. At the end of this, we will have a Q&A session. You can ask about the price, about the future, about the stockers. This is the first time that this report contains all related to stocks, all of this for the agency. Neil, is your floor. You will start right now. Okay?
Thank you, sir. Thank you very much. And, thank you once again for the invitation to come to Madrid to present the report. What I'm going to do today is in 2 parts. First, and the largest section, is to discuss the 5-year outlook that the IEA published earlier this year. That is out to 2022, main issues affecting the oil market. And then at the very end, I've got a little mini pack of slides which discusses the short-term oil market outlook. We published our monthly oil market report in the middle of last week, so it's very topical, and it caused a little bit of a stir in the market, and I can just give you a brief description of that. But the main order of business is the 5-year outlook, and we'll get straight into that. The basis on which we made the 5-year forecast is simply this. We took the futures curve out to 2022, 2023, in fact, as we show on the graph, and at the time we made the report, the line at the top, the brown line, the thinner line, that was the price curve that was revealed to us at that time, on which we based the demand and supply outlooks. And the objective was that if this price outlook were to prevail during the forecast period, what would it mean for demand and supply and the market balance at the end of it? And that's what we're building up to show you. I added just the other day, before I came to Madrid, the forward curve as of, I think it was yesterday, 19th of June. And it shows you that whereas we had a pretty flat outlook in the initial curve at the top of the slide, in fact, it's actually slightly steepened a little bit since then. But crucially, it is a lower level of prices. The price outlook, in terms of the actual level of prices, has declined in the last few months since we put our report together. So on the basis of the curve that we had when we did the initial report, we'll go through first what it means for demand, and over the period out to 2022, and we're discussing to 2022 in all aspects of this presentation, we see world oil demand continuing to grow. No sign of peak demand in our outlook, and it's growing out to 2022, but at a slightly slower pace as the years go by. As you can see, we had a very large increase in demand in 2015 in direct response to the dramatic fall in prices that we saw from 2014 onwards, and we've still had a pretty solid rate of growth in 2016. In 2017 and then in the successive years, we're seeing that rate of demand growth begin to slow. Now, within the total outlook for demand around the world, we have China and India between them contributing pretty well 50% or so of the total global growth. They are, of course, going to be extremely important in terms of the total growth out to the period. The world will be using, by 2022, 7.3 million barrels a day more than it is today. And that works out at roughly 1.2 million barrels a day growth each year, something like that. And we currently think that the world will reach the 100 million barrels per day level for oil demand some point at the end of, in fact, we say on the slide in 2019, but in fact that assumption has been brought forward slightly, and that 100 million barrel a day level will now be reached towards the end of 2018. So demand is going to continue to grow. Just a quick note on electric vehicles, because we're often asked about this. So there's a lot of excitement about electric vehicles, and the IEA itself has published quite a lot of interesting research on the subject. But even if during the 5-year outlook the use of electric vehicles were to grow rapidly, we see very, very little impact on oil demand. In fact, to the extent that it was easy to quantify it, we think by 2022 electric vehicles will only displace about 0.2 million barrels a day, 200,000 barrels a day of conventional fuel demand. It's very, very small indeed. Beyond 2022, of course, is another story. But the oil demand continues to grow at a slower pace, and the slowdown in this pace of growth is due to a combination of ongoing improvements in vehicle efficiency, fuel efficiency, structural changes in the Chinese economy as they move away gradually from heavier, more energy-intensive uses of oil in the economy, more towards a consumer-focused economic structure, and the ongoing structural decline in the OECD countries of mainly Europe, but also the United States and Japan, structural decline in the OECD. A point we'll come back to a little later on, tighter marine fuel standards, which is a not insignificant issue from 2020 onwards, but we think that is only going to have a modest impact on oil demand in the period to 2022, and we'll come back to that just a little bit later on. Moving on to just a little bit of background on demand. There's an awful lot to try and put over in this 45 minutes to an hour or so that we've got, and I'll try to fit it all in as best I can. Lower per capita consumption levels, of course, are supporting the relatively rapid growth in demand amongst the non-OECD countries. And as you can, I hope, see on the chart quite clearly, for India, for example, you've got a growth in the per capita consumption out to 2022. China starts to get a little bit more intensive, a little bit more efficient, but so certainly India will be improving its per capita consumption. But even by 2022, although India will see quite strong growth over the next few years, its per capita consumption is still only going to be half the current levels of consumption you see in China. And in India, the consumption will only be about 1/15 of the per capita consumption that you see in the United States. So there's a lot of growth to be done in some of the non-OECD economies, and that is going to be one of the key driving forces behind total product demand growth in the next few years. Within the total, petrochemicals and transport make up the majority of the growth that we're going to see. The transport sector, road transport, the maritime sector, the air sector, the airline sector, that is going to lead growth through 2022, and that will be roughly half of all the growth that we're expecting to see to the end of the period. And obviously that has implications for gasoline, jet, gas oil, and other transport fuels. The 2020 International Maritime Organization bunker fuel legislative change could trigger, depending on how how well it is implemented, a switch of possibly up to 2.5 million barrels a day out of high sulfur fuel oil, but a large volume of that will be switched to marine diesel, and some may also go to LNG, but that's another story. So there are quite a few things happening around the margins of the growth picture out to 2022. The marine quality change is something that has layers of uncertainty on it. But we are certainly seeing the petrochemical sector as well as the transport sector being the two main areas of growth out to 2022. Not all oil product demand, of course, is refined products. As we go through 2022, what we'll see is that there's not a great deal of change in the balance, but it's often an aspect of the market which not everybody always appreciates. They tend to think of oil demand as being refined products, but it's only about 85% or so of oil demand comes from refined products. And over the period, we'll see biofuels being a fast-growing product category at a rate that's probably about twice as fast as conventional oil products. And amongst the oil products, we'll see supply from natural gas fractionation. We'll see ethane, LPG, naphtha growing fast, probably by nearly 2% a year, as opposed to the conventional refined product demand going up by about 1.2 or so. Direct use of crude oil in the power generation sector is an issue that raises its head from time to time, as it has very important impacts on crude markets, particularly in the Middle East, where they burn a lot of crude oil in their power sector, particularly during the summer months. But we see the direct use of crude oil in power falling between now and 2022 as they switch in some of the Middle Eastern countries from oil to natural gas. Coal to liquids and gas to liquids projects remain fairly niche, but for countries that do have access to abundant coal and gas reserves, and there are companies in place that have deep pockets and access to finance, we could well see further developments there, but it will remain a fairly niche sector. Emerging markets, perhaps unsurprisingly, will dominate growth. The left hand of the two charts that we have up here at the moment show that in, I think it was 2013, the non-OECD countries finally overtook the richer countries in the OECD world in terms of their total oil demand. And as the years progress through to 2022, the non-OECD countries will begin to pull clear. On the right-hand side, we have the same graph with relation to motor gasoline, and the non-OECD countries are still behind the OECD countries in terms of gasoline consumption because, of course, they have far lower levels of vehicle ownership. But as we get towards the end of our forecast period in 2022, we see that the non-OECD countries are beginning to catch up in terms of gasoline consumption. Now, that's a fairly short and very, very superficial in terms of the massive amounts of detail that lies beneath it in terms of what's going on in oil demand growth. A lot of the interest we have found in the research and in the ongoing questions and discussions we have with our subscribers and with everybody else we deal with at the IEA is far more focused, at the moment at least, on the supply side of the balance. People seem to have, to some extent, taken for granted that oil demand growth is going to continue at a fairly steady pace over the next few years, and that certainly seems to be a consensus view. But people are now increasingly focusing on where is the supply going to come from to meet that expected increase in demand over the next few years. And at that point, we now make what I think is one of the key points, not just in the Oil Report 2017 that we published, but a key point that the IEA is making in many fora and in many reports and in many public statements about the state of investment in the upstream sector globally. What we have seen is that in 2015 and again in 2016, investment in the upstream sector fell in both those years by roughly 25%. Roughly 25%. The first period, we believe, where we have seen a fall in investment for 2 years in a row, since sometime back, I think, in the 1950s, although the data's a little sketchy. But certainly in the modern era, we have not seen 2 years of significant falls in investment such as we have seen. And that, of course, is an issue which raises concerns for the future. Essentially, having had many years, at the beginning of the chart, we have 2010. During 2010, 2011, 2012, 2013, into the middle of 2014, crude oil averaged, for Brent crude oil, roughly $100 a barrel, give or take. A few little excursions higher and lower from time to time, but broadly speaking, over that period, oil averaged about $100 a barrel. In the period since then, in 2015 and 2016, and of course now into 2017, oil has averaged roughly $50 a barrel. The price has halved, and that has had a dramatic impact on levels of investment. But following the consolidation of oil prices at around about $50 a barrel that we see today, although we become increasingly nervous as the days go by, as the price seems to be showing signs of falling below that. But for the purposes of this exercise, assuming consolidation of prices around $50 a barrel, there are some tentative signs, at least, that that producers are beginning to rethink capex plans, and there are tentative signs of an increase. Although in 2017 we think that the increase is going to be pretty marginal, somewhere between 3 and 7%. But of course, while investment has fallen, costs have fallen sharply at the same time. And we think that globally, upstream costs fell by something like 15% in 2015 and something like 17% in 2016. In the United States, the cost deflation that we recorded was even higher, and at something like 30% in 2015 and close to 25% in 2016. So while investment has fallen, so has costs, and that of course is very helpful in terms of seeing the path forward for regaining investment or seeing investment start to increase again. And in the second week of July, this forthcoming July, I think it is, the IEA is releasing a major report on trends in global energy investment, not just in the oil sector, in terms of the investments that are required in various parts of the energy infrastructure, and what are the trends in terms of meeting the energy investment requirements that have been identified. But in the immediate term, we've seen a dramatic fall off in investments in the upstream sector of the oil industry, and there are only tentative signs at the moment that companies are having confidence that there is some stability as far as prices are concerned, and stability that allows investment decisions to be taken. Moving on into the global oil supply capacity picture, what we have seen is that global oil supply did actually grow in 2016 despite a weak oil price environment, because we saw lower cost producers in the Middle East and indeed many of the OPEC countries boost their production quite dramatically in 2016. Russia also managed to increase its production to record levels. However, in the United States in particular, but other countries around the world which are generally higher cost regions and countries, we saw supply fall as investment fell sharply. In 2016, OPEC increased its total output by just over 1 million barrels a day, and the Russians increased their output by about 250,000 barrels a day or so, which more than offset some of the declines we saw in China and Colombia, which we'll come on to. As a result, net supply increased by nearly 500,000 barrels a day in 2016. Big increase in OPEC, a fall in the United States and elsewhere. Now, as we move forward, what we're currently expecting to see is that global oil production capacity will grow by something like 5.6 million barrels a day by 2022. And bear in mind that we're seeing global demand go up by 7.3 million barrels a day. So try and keep that figure also in your mind. Global production capacity going up by 5.6 million barrels a day. The non-OPEC countries are likely to contribute about 60% or so of that capacity increase. But as the chart shows, the capacity increase that we have, I don't have a pointer on this, do I? Or do I? Oh, it's there, yes. There we go. The capacity growth is very heavily front-loaded in the forecast. We have seen from identified plans from the companies, the national companies, the independent oil companies, we can see that in 2017 there is something of an increase in both the OPEC and the non-OPEC sector. But as we move into 2018, there's a big increase in production capacity because we expect, A, the United States to expand its production, but also longer-term projects that were put into play some years ago in Brazil and in Canada, Kazakhstan, and one or two other countries. They are still coming on stream. They've managed to cut their costs, and they will come on stream pretty well on schedule. So we see a fairly front-loaded picture as far as the global oil capacity growth picture that we've identified. Now, as we look beyond 2018 and 2019, based on what we can currently see, as opposed to guessing what might happen, based on the current known plans of the major companies, international oil companies and the national companies, the current expectations for capacity growth dwindle away quite sharply as we reach the end of the forecast period. And to all intents and purposes, by 2020, 2021, growth all but stalls, as it says on the bottom of the slide. So this message of gradually declining increases in production capacity around the world dovetails very neatly with the previous slide, which showed the dramatic falls in global investment in 2015, 2016, and so far only the very modest pickup that we have seen in 2017. The lower cost Middle Eastern countries are driving the OPEC capacity growth, perhaps unsurprising, with Iraq at the front of the queue. And we're expecting increases in countries such as Iran, the UAE, rather a more hopeful suggestion in terms of capacity growth out of Libya. That's perhaps rather more educated guesswork than a rather a sort of fully formed forecast. But Libya does, of course, have significant potential. But of course, it isn't all just a story of winners, Iraq, Iran, and some of the other countries. We do see that within the current OPEC family, there is a group of losers that we have identified. Qatar, which has seen very stable oil production, stable to slightly falling for many years now. And of course, Qatar is a huge LNG player. But also in some of the smaller countries such as Gabon, Angola, Nigeria, subject to a dramatic change in the political situation there that would allow new investment to take place. We're seeing production capacity falling in Nigeria over the next few years, and to some extent the same is true of Algeria, but perhaps most spectacularly of all, due to incompetence, stupidity, the breakdown of the country. Sorry, I speak on Venezuela with some feeling. Production capacity there is going to fall very sharply over the next few years. But net, taking into account the gainers and the losers, OPEC is going to add something like 2 million barrels a day of new capacity by 2022 in anticipation of steadily growing oil demand that we have forecast, and indeed many other countries, many other forecasters have a similar outlook. Iraq, as we said, is leading the capacity growth. what we have seen in terms of Iraq in the last few years is its actual production has increased very sharply in the last few years as to some extent the security situation in the key oil producing areas has stabilized, and as they have been able to invest in the sector. Of course, the investment was made a lot easier when oil prices were $100 a barrel, but the Iraqis have managed to make terrific progress in the last few years, and as we go forward into the latter years of our forecast, we see the Iraqis increasing their capacity up close to 5.5 million barrels a day, or that of course remains highly dependent on the stability of the security situation, and indeed it also depends to some extent on technical factors. They need an enormous water injection scheme to boost reservoir pressure in some of the key producing areas in Iraq, but they are expected to grow very, very, very sharply over the next few years. Moving on to the non-OPEC countries, as the graph shows us, in the period to 2022, there are a number of countries which will see their production capacity grow very strongly. The United States as the leader of the pack, and we'll have a little bit more on that in a moment or two. But it isn't just the US. We're also seeing very steady, sustained increases in capacity in Brazil and in Canada, Kazakhstan, and in one or two other countries, which perhaps might surprise us a little bit over the next few years. But so very, very strong production growth in a relatively small number of countries. But on the right-hand side of the chart, we do see the losers, and currently we've got a very small decline for Russia. In other words, essentially stable because it's such an enormous producer. But there are countries such as Colombia and China, which are not insignificant producers. China produces 3.5 million barrels a day, something like that. Colombia about 800,000. We do see continuing falls in production there. And Mexico, we have to be a little sensitive to Mexico because it's on the verge of joining the IEA, so we need to be nice to family members. But Mexico has been in long-term decline for many years, and of course at the moment there's a major program of reform around the whole of the Mexican energy sector, not just oil, and there are hopes, of course, to turn the situation around. But as far as the next 5 years is concerned in Mexico, we don't see a great deal of improvement, and they will continue to decline. But in 2016, we saw production by the non-OPEC countries as a whole fall by very nearly a million barrels a day. But as we're moving through 2017, we're starting to see non-OPEC output return to growth, and it is expected to grow quite sharply this year, and it will grow spectacularly next year, and we'll come on to that a little bit later on. Non-OPEC production goes up by 3.3 million barrels a day by 2022. Add on to that the 2 million barrels a day or so that the OPEC countries are concerned, and you're then getting towards the 5.5 million barrels a day or so of global oil production capacity that we were talking about earlier on. Now the United States, which is it seems to be at the moment, for those of us who are analyzing short and medium-term oil markets, what is happening to U.S. production? That is nearly always the first question that is asked, and it's, of course, crucial to the future balance of the market. And as we go into the forecast for that, to some extent, the numbers that we're showing here are a work in progress, because since we completed the work for this forecast in February, March of this year, things have changed to some extent, not dramatically, but things have changed. We're learning on the job, so to speak, about US output, and I'll mention a little bit more about that in a moment. But certainly the period up to 2017, we see having the light tight oil, the shale production, I should say, sorry, this is the chart we have currently, fell back from the middle of 2015 in 2016, but it's starting to expand again. And by 2022, using our base case future curve price outlook, we see the shale production expanding by about 1.5 million barrels a day by 2022. As an illustration, if the price were by some miracle to increase to $80 a barrel, we see that the production could expand by not 1.4 million barrels a day, but potentially 3 million barrels a day over this period. And perhaps slightly embarrassingly, because sometimes truth comes back to bite you when you're making forecasts, we had a lower price case at $50 a barrel, which of course is pretty well where we are today. And while we see growth, of course, we do see a gradual decline, or currently we see a gradual decline in US production at a $50 barrel case. But as I say, this is a moving feast, and there's a great deal of new information which is being revealed to us almost on a daily basis. And I do make the point, I think this is either attacking forecasters or defending them. I'm not entirely sure which it is. But in the first phase of development of the US shale industry, which started in about 2008, you will find there were very, very few forecasters, or indeed people working for the companies themselves, that could have predicted that total US crude oil production would increase from 5 million barrels a day in 2007-2008 to 9.5 million barrels a day by 2015. Very few people saw that rapid rate of growth, and equally, very, very few people foresaw that as the oil price, having plateaued at $100 a barrel for a significant period of time, fell from 100 down through 90, 80, 70, all the way down to $30 a barrel at the beginning of 2016. Few people foresaw the resilience of the US shale sector as the companies, faced with lower prices, yes, did shut in some production, of course, but many companies were able to find efficiency improvements, cost-cutting measures of one type or another. They were able to hedge their production. The resilience of the sector was something that I think took pretty well everybody by surprise. Now, here we are in the getting close to the middle of 2017. We've had a situation where oil prices have, to a large extent, stabilized at roughly $50 a barrel. And we are now in a situation where the US production growth is picking up again. It's starting to grow again. And this is the third great uncertainty that we have in trying to understand how quickly this second wave of growth, how rapid the pace of that will be. And we can come on to that in a moment when I show some slides on the very short-term oil market outlook. But the US situation is very highly price sensitive. But we have underestimated the resilience, we have underestimated the technical ingenuity of the people working in that sector, and also their financial ability in terms of being able to maintain access to finance and to be able to hedge the revenues from their production. Just one other region which has caught us by surprise over the last few years is the North Sea. And I can remember back as early as the early 1980s, the mid-1980s, people writing obituaries for the North Sea sector that it would fall away very, very rapidly in the 1990s, and certainly no later than the turn of the century. And while it has fallen away, as the graph, the pattern of the graph clearly shows, what we have seen very recently is aided by higher prices, of course, in the middle years of this decade, stabilization. Again, technical ingenuity, the ability to do more for less, the ability to extract resources in ways that were thought impossible a few years ago. And even in the North Sea, the obituary for which had been written many times, we're seeing stability and even a very, very slight growth over the next few years. Moving rather sharply onto the refining sector, I'm trying to cover as many bases as I can. In 2016, we saw an extremely rare event when global refining capacity actually declined year on year due to essentially the number of planned shutdowns exceeding the commissioning of new capacity. A few projects that were actually finished in 2016 didn't enter production that year and are being postponed into 2017 and in one or two cases to the later part of the year. But over the next period out to 2022, we do foresee a more than sufficient increase in capacity in the refining sector. And there are something like 70, we've identified 70 greenfield refineries or expansion projects materializing between now and 2022. And taking into account, excuse me, projected shutdowns in Japan, the Middle East, and in one or two other places, we think the net additions to refining capacity are going to be something like 7 million barrels a day. But the Middle East and China will dominate that growth. They'll account for well over half of all the capacity additions. In India, the capacity growth that we have seen in recent years has been pretty rapid. That capacity building is beginning to slow down as many of the bigger projects have already come online. And currently in India, we're only really seeing capacity expansions at existing refineries. But that's not, of course, insignificant. And there will be still significant amounts of spare capacity in the sector. And currently there's something like 15 million barrels a day of distillation capacity remaining unused. And that, of course, that's not a new phenomenon. We've always seen traditionally very high rates of spare capacity in the refining sector, certainly going back to the early 1980s when we had 3 years in a row of declining global oil demand, and Europe in particular was a region where there was a lot of spare capacity. But and as I said, as far back as the data go, we've always seen unused capacity. And while we're looking at 15 million barrels a day or so today, in the early 1980s, that figure was as high as 25 million barrels a day, which is an extraordinary number. And in Europe, of course, there were a lot of refinery closures as the companies started to cut out the less efficient capacity and make the necessary adjustments to the market reality. But even though China has now become the second biggest oil market in the world, using something like 11.5, 12 million barrels a day, and it's invested a great deal in its refining sector, China now has too much refining capacity. And since much of that excess capacity dates back to the first wave of investments that were made in the late 80s into the 1990s, when China really began to take off. And a lot of that capacity investment that was made in the late 80s, the 90s, even into the very early part of the new century, was essentially the wrong type of capacity situated in the wrong places. And as the economy has developed and the product needs in China are beginning to move away from the heavier energy-intensive oil products towards transport fuels and the petrochemical sector, what we're seeing is capacity essentially finding itself out of date and in the wrong place. But China is still obviously going to see a lot of upgrading. It will see growth in capacity at existing facilities. But we will have to see if there's going to be a wave of write-offs of redundant units. And at the moment, we're unsure what will happen and whether or not those units, which have been held by the bigger companies in China, will perhaps fall into the hands of the so-called teapot refiners, the small or smaller companies in China, which have been very active in recent years in growing their share of the market. So we might see some of the older plants continue to have a life, but under new ownership. Just very quickly, we mentioned earlier on the issue of the global marine bunker fuel structure based on the new regulations which the International Maritime Organization is bringing in 2020. We think currently, if the IMO regulations were actually to be widely implemented in 2020 or soon thereafter, that because of the fact that there is ongoing strong growth in gasoline and in diesel and jet fuel, that the current refineries, or as they are currently configured at least, are going to be very, very hard pressed to produce enough low sulfur marine bunker fuel. Certainly, the competing demands on on diesel fuels because of the growth in demand for on-land transport, trucking, railroads, and other uses, they're going to come head-on into rising demand for marine diesel fuels for the maritime sector, and there's a big challenge that lies ahead. And what will happen in 2020 is, of course, difficult to know. Whether there will be, in fact, waivers granted by the International Maritime Organization, whether there'll be some kind of blending that takes place between marine diesel and fuel oil, whether there'll be an increase in penetration from LNG as a marine fuel, or whether, in fact, the regulations would in fact be widely flouted, which is an expectation we have for some parts of the world where perhaps enforcement of legislation is a little less rigorous than it is in other places. But it's a big issue which is dominating the thinking of the maritime industry, and it's something that we did do quite a bit of work on in the oil report. On the basis of the fact that Asia is the biggest single growing market, China and India in the lead, but other countries as well, of course, by 2022 there will be no crude oil exporting country, net crude exporting country in Asia. And Asia's requirement to bring crude into the region for refining will be growing by about 3.6 million barrels a day, from 21 million barrels a day up to 24.6 million barrels a day. And there are big changes going on in the regional balances, as we see in North America, because of the rapid growth in production in the United States. Their net import requirements is going to be falling over the next few years. The Middle Eastern countries will have more volumes available for export, but it won't be enough to meet the increase in demand from the Asian economies. And we have a little chart here which is actually quite clever. So clever, it's certainly one that I wasn't able to construct myself, which looks at how the Asian economies are going to fill the gap to find the 3.6 million barrels a day that they're going to need over the period to 2022 to refine, to make the products that they're going to require. The Asian countries, as we saw a moment ago, they will continue ramping up their refining capacity in the next few years to meet growing demand, but the production within the region, as we said, is going to decline. So net crude oil imports are going to increase. China is already the biggest importer of crude in the region, and it's going to increase its lead over the other countries. And by 2022, it will be bringing in 9.5 million barrels a day, very close to the historical record achieved by the United States. So we've got Asian imports increasing over the next few years. China in the lead, India seeing a significant increase in its requirement, and then other Asian countries. Malaysia is one example, but many other of the Asian countries. And so the question is, where are the Asian economies going to get those imports from? We use the phrase, which is a rather quaint British phrase, east of Suez, which I guess I should apologize for, but sometimes you can take the man out of Britain, but you can't take Britain out of the man, and we've used this phrase, east of Suez. So where is the supply going to come from? Well, as we saw, the Middle Eastern countries do have extra volumes available. They will be increasing their production capacity, and they will have additional volumes available for export. So the Middle East will be supplying more oil. Brazil, which is one of the countries with the US and Brazil and Canada, which will see significant increases in production over the next few years, Brazil will have volumes available to ship to Asia, as will Canada, one of the big three countries seeing big increases in production. The rest, possibly increases in exports from the former Soviet Union. That's a phrase I wish we could get away from, but we're still using it at the moment. Russia to some extent, but also increasingly Kazakhstan. And the rest will come from reduced imports into the United States and Europe. Those volumes will be diverted from Europe and the United States to Asia. So there are going to be, as we describe in the bottom of the chart, tectonic shifts in global crude trade flows. The volumes, by the way, I should have perhaps given you the volumes. Brazilian exports can increase by almost 900,000 barrels a day. We'll see 800,000 barrels a day coming from Canada. The former Soviet Union countries taken together can probably supply about another 500,000 barrels a day or so, something like that. So we're talking fairly significant volumes as the period out to 2022 comes along. A couple of quick slides on stocks and storage. In the early part of 2016, as the oil price was going to very low levels, and as 2016 progressed, stocks were building as they had done throughout 2014, 15, and into 16. And the issue then arose about storage capacity. Where is this oil all going to be stored? And there was indeed some rather alarmist headlines about there is no place to store this oil, which is of course always nonsense because you can always find somewhere. But we did some work in our report this year trying to understand where there are investments being made in increasing storage capacity around the world over the next few years, because stocks are likely to remain at higher levels than we've been used to historically for some time to come. And we've identified getting on for 250 million barrels a day or so of capacity that is under construction or is being expanded around the world, but most of it, the majority of it, is in the Asian region and to some extent North America. So there's a lot of investment taking place in the expansion or the construction of new storage capacity around the world. China in the lead, the United States, Korea also. But there is investment taking place, and that's quite important in the future if we are going to remain in a world where oil stocks are high compared to historical norms. And of course, segueing very neatly into the issue of OECD oil stocks, and I'll come back to this in a moment when we look at the very short-term oil market outlook, is that the OECD oil stocks, which is the oil stocks, or for the countries where we are able to very accurately measure the actual levels of stocks, they reached record highs in 2016, something like 3 billion barrels of crude oil and products held in the OECD countries. And it's the surplus to the 5-year average, which is a line shown on the right-hand axis. It's this line here. That surplus reached something like 350 million barrels a day at the end of the year, something like that. Stocks have reached historic highs, and that is one of the key factors behind the fact that as we move through 2016, as we move through the latter part of 2015 into the early part of 2016, and we saw oil prices fall to $30, it was the fact that production had been growing in the United States. It was growing in some of the OPEC countries, but growing into an already very, very highly stocked world that we saw price pressures take us all the way down to $30 a barrel. As we go through 2016 and into 2017, and we'll come on to this in a moment, stocks have remained stubbornly high versus the 5-year average. And at the end of 2016, as the OPEC countries were deliberating whether or not to cut their production, we had found that stocks were remaining very high, and the expectation was at the end of 2016, looking into 2017, that unless something changed in the market, stocks were so high and were going to be added to by continuing high production that they would essentially topple the market over. And it was that perception which led to the OPEC production cuts at the end of 2016. But I digress for a second. We get to the essentially what is the culmination of the message that we put forward in our 5-year outlook of gradually increasing demand, but investments in production capacity lagging behind that growth. And what we're seeing, and the way we have expressed this, because OPEC retains the role of the swing producer, but crucially is the only group of countries where there is significant spare production capacity. We see, as the chart currently shows, the OPEC capacity growing over the next few years by about 2 million barrels a day or so. But the requirement on OPEC, the call on OPEC over that period of time also increases, so that by the 2020, 2021, 2022 period, what we see is that the cushion of spare production capacity available in the world, expressed as a proportion of global demand, shrinks to about 2%. Now, back in 2008, when we had a period of time when oil prices increased extremely rapidly, right way up to $146 a barrel, the spare production capacity then was just under 4%. Now, we are not saying that if this market outlook comes to pass with the shrinking of the spare production capacity, prices will go to $146 a barrel. We don't know that, and we cannot know that. But based on what we currently know for demand, growing up by 7.3 million barrels a day to 2022, based on what we can currently see with respect to global production capacity, there is a shrinking of this spare capacity cushion, with the dangers that the market is faced if there are unplanned production interruptions, whether it be politically led or industrially led. So this is a danger for the market as we go ahead to 2022. And of course, behind all this is the fact that global investment has fallen sharply for 2 years in a row. It's only beginning to pick up very, very weakly now. So we are in a situation where, based on the snapshot taken at the beginning of 2017, a tighter market, some security of supply concerns as trading patterns change, as voyages lengthen. This could lead to increased volatility and higher prices by 2020, but that of course remains to be seen. Now what I thought I'd do,
Change to this.
yeah, very, very quickly for just a few minutes, because I appreciate I've used up a lot of time, is just put up a very short slide pack, which is the IEA's views on the current oil market as of today, the short-term oil market. And as I said at the beginning, we published our monthly oil market report in the middle of last week. And the most noteworthy issue as far as that edition of the oil market report is concerned is that we published for the very first time our detailed outlook for the year 2018, our quarter-by-quarter breakout of the oil supply and demand trends. And what we are showing you is that a few moments ago we were looking at global oil demand increasing by roughly 1.2 or so million barrels a day on average out to 2022. What we're seeing in 2017 already is that the growth is slightly higher than that in 2017. It's about 1.3 million barrels a day, something like that. And currently our expectation is that demand growth will actually accelerate in 2018, not by a great deal, but it will accelerate nonetheless to about 1.4 million barrels a day. Now, the interesting point about that is that in the very beginning of 2017, in the first quarter of the year, we actually saw one of the lowest year-on-year increases in demand that we've seen for about 2.5 years or so. And one of the reasons for that was that, as you may have appreciated, in India there has been weaker demand growth recently because of a currency reform that the Indian government made, where they withdrew a lot of old banknotes without first ensuring that the supply of new banknotes would be available immediately. And it caused a great deal of disruption and chaos in an economy that is very heavily dependent on cash transactions. So we saw a slowdown in growth in the earlier part of this year, but we think it's beginning to pick up again as we move through 2017. And the pickup in demand, the slight acceleration in demand that we see in 2018 is partially dependent on a stronger year-on-year response in India, but also to some extent in China as well, as the transport sector there continues to grow fairly robustly. So we're seeing accelerating demand growth in 2018. But, and this is one of the most striking conclusions that we published last month, is that, as you can see perhaps from the little bar at the bottom of the graph, is that non-OPEC production, led by the United States, but also including Brazil and Canada, Kazakhstan, is returning to growth this year, and it'll grow by something like 700,000 barrels a day, something like that, for the year as a whole. But in 2018, non-OPEC production growth accelerates tremendously, up to about 1.5 million barrels a day. Now, bear in mind that we're showing global demand growing by about 1.4 million barrels a day next year. Of course, the final numbers will be slightly different, but essentially what we are saying is that global demand growth will be at least matched by the increase in production from the non-OPEC group of countries, US, Brazil, Canada, Kazakhstan, and one or two others. And that, of course, has implications for the balance of the market. There is two slides which I'll show you on that. And we were looking at stocks having increased sharply in the OECD countries in the last few years, but more specifically today. The OPEC countries, supported by 11 non-OPEC countries, agreed at the end of last year to cut their production by a combined total of about 1.8 million barrels a day, something like that. The OPEC countries have largely kept their side of the bargain in terms of the group as a whole. Not all the countries have been as diligent in cutting as others, but the OPEC countries as a whole have largely kept to their side of the bargain. The non-OPEC countries slightly less so, but they've still managed to cut their production. But what we are finding is that it's one thing to actually cut the production, but of course the production was cut from very high levels, because we saw during 2016 the OPEC countries see very rapid rates of growth. We saw Russia grow. So while they were talking for 8 months nearly about the need to reach an output deal, cut production to try to balance the market, while they were talking down, their production was going up. So a lot of oil which was produced in the last few months of 2016 was still taking its time to find its way to market, and it's showing up in OECD total oil stocks. And so far in 2017, and what that means is January to April in terms of complete data, but to some extent this is probably true of May as well, we have seen total stocks, crude and products taken together, in the OECD countries actually go up and not down, which is of course the wish of the OPEC countries. And in terms of the relationship of the total OECD stocks to the 5-year average, and I make it clear that measuring stocks against a 5-year average is not something I personally would prefer to do, but 5-year average seems to be the currency that the leading producers wish to measure stocks by. The 5-year average is their target. We see that OECD stocks versus the 5-year average are still nearly 300 million barrels above that average figure. And based on our current outlook for supply-demand moving through 2017 and 2018, we believe that there is no chance that the level of stocks will fall to the 5-year average level, certainly by the end of 2017, and quite possibly by the first quarter of 2018, when the current OPEC, non-OPEC production accord comes to an end. Now, having said that the OECD stocks have actually gone up in the first quarter or so of 2017, we do believe that based on our current expectations for the level of oil demand and the level of oil supply in the market today, the implied difference is for a stock draw of about 0.5 million barrels a day in the current quarter. But that's the gap between demand and supply. Demand is higher than supply by about 0.5 million barrels a day. However, as real data starts to come in, as improved data comes in, revisions are made, we get better data for stocks as well, it might well be that that desired stock draw in the second quarter of this year will either not materialize or will be less than we're currently projecting. But on the same basis, as we look into the second half of this year, the gap between demand and supply on our current numbers does widen, and we currently believe that in the second half of 2017, taken as a whole, that demand will exceed supply, and thus stocks will draw by roughly 1 million barrels a day. It could be higher. It could be higher. So, as the second half of 2017 progresses, the oil producers could finally start to see their wish, and that stocks will begin to fall. But they will be falling from a very great height, and they will not be falling fast enough to reach the totemic level of the 5-year average, at anything like as quickly as the producers actually want. So that's essentially what all I have time to talk about in terms of the short-term market. Picking up, demand picking up, non-OPEC supply, however, expanding dramatically, certainly in 2018, having expanded also this year. The market rebalancing is much slower than expected. Large draws in second half of the year. I've actually put a question mark after that because it remains to be seen. We haven't focused much on price levels because the IEA itself doesn't actually forecast prices. However, what we are seeing today in the market is that today's oil prices are essentially back to where they were when the output cut agreements were announced at the end of 2016. They were higher for a while, but they've now fallen back, and today they are at the same level, in fact, possibly slightly below even. So as we look into 2018, and we're now publishing 2018 forecasts every month in our oil market report, there is a huge challenge to the OPEC countries. They perhaps cannot afford to abandon their production agreement if the current market balance that we believe will happen actually takes place. I'll stop at that point because I know I've spoken for a very long time and perhaps tried your patience. And if there are any questions or observations, we are very happy to address them.
Okay, thank you very much, Neil. Pleasure again of having you here. Maybe we can have some questions for the audience. This is about the prices, about whatever you want. Let micro to Alvaro.
Yeah, we have one there.
We have another one on the back.
Please.
You can ask.
Okay. Thank you very much for the speech. I would like to ask about Qatar and the issue that's happening now with the Gulf. If that have anything to do with the output for next year and the gas that they produce. Thank you.
Sure. Yeah, I can take that one now because it's a fairly easy answer. We've made no assumptions of changes to existing production and export levels. It's very hard to know what exactly will happen. So far, based on observations of tanker tracking movements, satellite analysis, there is no change to the normal pattern of trade. That might start to change if Saudi Arabia, the UAE and the other countries start to actually impose the ban they've discussed in terms of allowing ships that have already loaded crude oil in Qatar to call in their country, or ships that have loaded crude oil in their country to call at Qatar. That could cause disruption, but Qatar exports about 500,000 barrels a day of oil, something like that. But we're not factoring in, at the moment, an interruption to supplies. It's just too early in the game to understand what's happening. I don't want to talk much about LNG because I don't know a great deal about it, but suffice to say that Qatar is enormously important in global LNG markets, not just outside of the region as a major supplier, but also within the region. Qatar is an enormous supplier of gas to the United Arab Emirates, who is one of the countries which have combined to attempt to place sanctions on Qatar. So there's a great deal of, or a lot of very complicated dynamics taking place. But as far as this outlook is concerned, we have, as yet, made no changes to our numbers with respect to the Qatar situation.
Thank you. Congratulations for the presentation. Very clear. I have two questions. The first one is regarding the oil market, the crude market. As you highlighted, the picture is big production increases next year, and during the rest of the second half of the year, huge inventories all over the place, with stocks in OECD countries at maximum level. What could be the possibility of the announcement made by Mr. Trump regarding the strategic petroleum reserve release over the next year, that now are nearly 800 or 870 million barrels, and if they plan to reduce that to half, saying that they have said something similar, that could have a huge impact on pricing also, no? Because probably the overproduction that there is in the next months, the huge inventories, and more crude available if the Strategic Petroleum Reserve release some of their stocks, that is a very signal in the, at least to maintain the current level of prices, or even lower levels. The first one, and the second one is in refining in Europe. The agency, how is your views about the reducing capacity in Europe? All the refineries not outdated, that don't have been able to invest. How you see the picture over the next 4 or 5 years?
Okay, both.
Okay, the first one, as far as the SPR is concerned, our understanding is that the drawdown of the SPR is going to take place actually over quite a long period, certainly possibly 8 to 10 years, rather than happening immediately, because clearly, if it were to happen immediately by any chance, it would have a material impact on the oil market, and clearly it would have a deleterious effect on prices, which would affect U.S. domestic producers of oil. And so, if for that reason only, we do not anticipate that the drawdown of the SPR is going to have a material impact on the market balance, because we understand that it will be a very, very long phased-out drawdown. And of course, what will happen is that the SPR stocks will just move from the SPR into the commercial stock level. So, of course, the total volume of stocks doesn't change. It just becomes commercially available rather than sitting in the caverns. But our understanding is that it's being done over a very, very long period of time, for the very reason that they do not want to adversely affect the oil price, because it will hit U.S. producers. It's quite interesting because the Strategic Petroleum Reserve contained until very recently just under, I think it's actually 700 million barrels, 697 I think was the precise number, of mainly, well, it is exclusively crude oil. In addition to the 697 million barrels of crude oil in the strategic stocks, there are at the moment about 520, I think it is, million barrels of commercial crude oil held around the United States. So taking the two together, it's 1.2, 1.3 billion barrels, which is way beyond any real operational requirements in the event of a crisis. And of course, the SPRs have been at roughly the same level for a very long period of time. It's the commercial stock which, of course, increased dramatically. And it makes a great deal of sense, given that domestic production in the US is increasing, or will increase for the next few years. So there is less of a security of supply concern that there was when the SPR was originally established at the end of the 1970s. So it makes some sense, given that domestic production is increasing, they are able to reduce the SPR, to obviously cut the operational costs, but also use the money for the purposes that the government has identified, which I gather is something to do with medical research, although I don't fully understand the full story about that. As far as the European refining is concerned, I can't really answer that in a great deal of detail. Suffice to say that because the European market, the European products market, is in long-term structural decline, which it is, even though we did actually see 2 years of growth in 2015 and 16 in response to lower prices. And even though that rate of decline is less than we thought a few years ago in the $100 a barrel world, there are still challenges in terms of shutting capacity. And of course there have been major developments, particularly in the UK, in my own country in recent years, which is fast heading towards a situation where it will have very little domestic refining capacity. The plants are being converted to storage and for other infrastructure purposes. But around Europe, we are in a situation where the product mix is changing. Europe is still a very, very large producer of gasoline. Produces way more gasoline than it actually needs, and it's finding, the European refining sector is finding that the United States is now competing with it very strongly, because the United States has now become an enormous product exporter, 3 million barrels a day or so product exports, many of which find their way to markets that the European gasoline surplus was targeting. Not just the United States itself as a market for European gasoline, but West Africa, some of the Latin American countries. So Europe is facing fresh competition from the United States over the next few years, as well, of course, as the ongoing increases in capacity in the Middle Eastern countries. So for Europe, we have the issue of the mismatch between the gasoline surplus they've still got, the lack of diesel. Europe is diesel short, the lack of diesel capacity in the region, and the fact that at current prices or in the current investment climate, it is very difficult to make investments to change configurations, and it's a very mixed picture. But I can't really say a great deal beyond that. I can actually, if you wanted me to, I could send you some more detailed breakdown of the refining research if you wanted to see that.
Any more questions? You will have over there 2 questions. You can identify yourselves.
Good morning, Pedro Medina from CEPSA. Congratulations for the presentation. Thank you very much. My question is, how do you think bunker market could cope with enormous deficit in the low sulfur fuel?
Are you talking particularly with relation to the marine diesel, to the marine diesel switch? Is that the main context that you're in which you're actually asking the question?
You can add something more about this? No.
Not a great deal more, no.
No, this is...
Well, what I can do for you actually is, again, there's a big section related to the marine bunker issue, and I can send you that separately rather than trying to go into that in great detail now. It's a hugely complicated picture, and as I think I said in the other remarks, as far as the marine sector is concerned, we're very unclear how they're going to deal with it, because we don't think there is going to be enough marine diesel available. We just don't see how that can happen, given the conflicting demands on diesel fuels as a product grouping from road, from air, and the rail sector and other areas. So, is there going to be some kind of blending? Will LNG be used to some extent? Will the regulations be flouted? But I can send you some extra research on that if you like. If you want to identify yourself afterwards.
Thank you very much.
¿Sí? Sanchez de Endesa. First of all, good presentation, and second, the questions. The first question is, how is, in your opinion, going to be the future crude oil production and natural gas production in Libya? And the second, why in Equatorial Guinea you propose a decreasing level of production? Thank you.
Sorry, Equatorial Guinea.
Guinea.
Did you say? Okay, sorry, I didn't hear initially. Yeah, Equatorial Guinea. Okay, I'll deal with Libya first. I think I used the phrase when I was talking with you earlier on about Libya being educated guesswork. The problem we have with Libya is that yes, prior to the revolution there, they were producing something like 1.6 million barrels a day, and had been producing at roughly that kind of level, maybe slightly lower, for many, many years. In theory, most of the infrastructure remains in place in varying degrees of usability. But of course, as you know, they have the two governments, they have the split. We have regularly seen the phenomenon where Libyan production appears to have made some sort of recovery, some sort of comeback, and then there is an outbreak of fighting, or there is some difficulty or whatever, and it falls back again. But recently what we have seen is that production in Libya, I think in the last couple of months or so, has reached, it's around about 700,000 or 800,000 barrels a day. And that's the highest figure we've seen since I think some point in the middle of 2014. So tentatively, there does seem to be some kind of stabilization taking place. But, you know, like everybody else, we look at Libya from the outside and we follow the news because it's a news-driven story. You read of facilities being invaded by rival militias which are taken over, which leads to the cessation of operations. Libya is a very, very hard story to follow, but to the extent that we are able to understand it along with everybody else, it does seem to be stabilizing at a higher level than we have seen for some time to come. Now, whether it's going to be able to continue to grow, we read in the press that that officials in Libya talk of reaching 1 million barrels a day by the end of this year. And I've even seen figures of as high as 1.2 million barrels a day by the end of the year reached. We don't know what will happen. I wish I did know the answer to that. But finally, on that subject, of course, while we have been watching the OPEC countries cut their production to try to bring down stocks and support prices, Libya is one of the countries that was not part of that agreement. And of course, when the deal was originally made, nobody really thought there was any chance of Libya beginning to see its production go up. So of course, all these extra barrels coming from Libya, and indeed from Nigeria, which is also outside of the current production agreement, they are suddenly beginning to seriously erode the effectiveness of the cuts from the other OPEC countries. So we're watching Libya very closely. We have factored in our medium-term planning an increase in capacity from Libya, but it's very much educated guesswork. Now, as far as Equatorial Guinea is concerned, Equatorial Guinea is a country that more recently we seem to have expended a great deal of time on, because it has, of course, firstly joined the non-OPEC production cut deal, and now it's also actually joined OPEC. So it's had a little bit more attention more recently than has currently been the case. And we have found it very difficult to get accurate information about what is the current level of production in Equatorial Guinea. Do we have press present?
Press? No, we have press presence.
We do. We don't have press present.
We don't.
Okay, right. The
It's
Chatham House rules. The OPEC Secretariat is charged with understanding what the OPEC countries are doing in terms of their output cuts. And they're also looking at what the non-OPEC countries are doing with their output cuts. Now, you would think that having negotiated an output cut agreement, all the parties to the agreement would be sharing data so everybody knew what was going on. You would think that that would be the case. In the case of Equatorial Guinea and one or two others, OPEC has no idea what they're doing because they're not supplying timely data. we at the IEA have been trying to understand it as well, based of course on tanker tracking, which is one of the clearest sources of data, but of course that doesn't tell you the full story. And at the moment we are unclear as to exactly what Equatorial Guinea is doing, but if OPEC don't know what they're doing, then there's not much hope for the rest of us. Now, as far as the future production profile for Equatorial Guinea is concerned, we are currently showing a modest decline over the period to 2022. But it is highly possible that now that it has joined OPEC and it's taking its place at the big table, this may be part of a wider push to raise its profile, not just as far as the oil political table is concerned, but perhaps in terms of attracting investment. And it may well be that the modest decline to 2022 that we currently show for Equatorial Guinea, that could change. But at the moment, we're very unclear as to what is actually happening today, let alone in 5 years' time.
Okay, maybe you can comment the last question from there. This man, two questions together, and he answered both. Okay.
Okay.
First of all,
I'm Manuel Regueiro from the Spanish Association of Professional Geologists, and the first question is: in view that all production predictions seem to fail in terms of price or production, or because it changes immediately. The first question is, what probability do you give to your report of being correct?
Oh.
And the second question is, there are a lot of voices now saying that the future of oil is closing down because the society doesn't want it. And if you ask people here, they will tell you that they will rather have an electric car because it's cheaper, it has less spare parts, and if you ask people here, they would like to have electricity produced not from oil, but from panels and having accumulators at home. And this is the trend. So some people are saying that the oil business will end abruptly, as it happened with the coal business, substituted by oil at the time, and many other things that have happened. Kodak, for example, have an excellent film factory that went bankrupted because of the digital era. So, your view on the future.
Okay, I'll try to. Sorry.
maybe you can pick another one at the third. You can answer the third question.
He's asked three enormous questions.
The third, because it's 2 p.m. Okay.
Okay, good afternoon, Jal Chakur from Repsol. Thank you very much for the presentation. It's really great. Just briefly, you mentioned, and come back to my colleague from TEPSA. He made a question about bunker fuel. You mentioned that refineries, this is something very obvious, to be pressed each time more to produce low sulfur fuel oil. This is due to always connected to the switch to marine diesel and to the IMO regulations. My question, does your report consider any follow-up of refineries that have already carried out such a switch? And the second point, I would appreciate if you send me the same information. I'll identify myself afterwards.
Happy to do that. Okay, I'll try and be brief. The forecast.
The last one for...
As far as the forecasts are concerned, at the end of this forecast period, 2022-2023, I will be 65 years of age, and I will be forced to retire. So I hope to get out of the building and be out of the country before they find out that the forecast has turned out to be completely wrong. As far as forecasts are concerned, in all seriousness, I've been involved in this on and off for 30-odd years now, is that we're taking snapshots at a moment in time, and we're taking the best information we have, and we're trying to understand the trends as best we can. And yes, we will be wrong. In how we will be wrong this time, I'm not entirely sure, but I have a box in storage in England which has got various forecasts and documents that I stole from the various companies I worked for over the years, which were forecasts made in in the early and mid-80s, some of them, looking at the world in 2000 or 2010 or whatever. And they are all extraordinarily wrong. It is incredible. But it isn't to say that we're all idiots, because obviously we're using the tools at our disposal. We're trying to take into account legislative changes, the climate change agenda, and everything else. And we do the best we can. I don't know what else I can say, frankly. I come out with my hands up in 2022, 2023, when you point out how wrong we were. The end of oil. Well, as far as certainly the 5-year outlook is concerned, there is no sight of peak oil demand in this 5-year period, and I would venture to suggest, and indeed my long-term colleagues at the IEA that publish the World Energy Outlook, they are forecasting that oil will continue to grow, although at declining rates, yes, possibly out to 2030 and probably beyond that. And the main reason for that, which comes on to your third point, is that the increase expected in transport fuel demand, conventional transport fuel demand, from countries where the level of vehicle ownership is very low, India, 12 or 15 vehicles per 1,000 people, something like that, China now about 80, give or take, the US 800, the UK, is it 600 here? Yeah, that's typical for a rich European country. There's an awful lot of growth ahead. Now, I acknowledge and can see that huge strides are being made in India and China, not least, in terms of attempting to encourage the development in the longer term of electric vehicles, and that will undoubtedly come to pass. I entirely accept that. But in this 5-year period, and probably the 10-year period, given the size of the conventional fuel fleet, given the continuing issues over range of electric vehicles, the issues over infrastructure for recharging, all of those things, I don't think that day will come for quite a long time to come yet. I believe it will come, I agree entirely with you, and I also venture to suggest that it should come. In the meantime, I am a person who, for the last 14 years, because of the way my life has developed, have not owned a car. I've lived in London and now I live in Paris. I haven't owned a car. I hope that the next time I do own a car, it'll be an electric vehicle. I would be absolutely delighted. But I don't know when that will be, and we'll have to wait and see. Sorry, you asked great questions, and I can't really do justice to them in the time that we have, and I thank you for them.
Okay, I think the last one is you will send to the bank
Sure.
to people. Okay, thank you very much for coming. Neil, thank you very much for coming here. It's a pleasure having you here.
Thank you.